Okay, let's dive into something really fascinating that you sent our way. We've got these excerpts here from a YouTube video transcript,
Yeah.
and it's all about this very specific kind of unusual term, apparently popped up on Wall Street.
That's right. It's a term that, well, according to this source anyway, it was coined to capture a perceived pattern.
A pattern.
Yeah, about how the markets react to certain tariff threats made by a particular president and sort of what happens afterwards.
Right. So our mission here for this deep dive is to really unpack this source material. We want to get what this term means, figure out where the source says it came from, look at the examples they give, and see what this source claims the whole pattern reveals about, policy making and the financial markets.
Exactly. It's really about digging into this source's take on it all.
And the term itself is just, well, it's called the taco trade.
Yeah, the taco trade.
We definitely need to figure out what Wall Street, or at least what this source claims Wall Street means by that. And the transcript kicks off with something pretty interesting.
It does. It describes this exchange. A reporter directly asks the then president about this exact term.
Wow, okay, so what happened?
Well, the reporter apparently brought up taco trade and suggested it was being used on Wall Street to imply he chickens out on his tariff threats.
Chickens out, okay.
And that this sort of perceived backing down was linked to markets going up.
And how did the president react? Based on the transcript, I mean.
Oh, immediately. And pretty strongly. The source quotes his reaction as basically denial and calling the question itself nasty.
Okay. So he pushes back. The transcript details his defense against that idea, right? What did he bring up?
Well, according to the source, he defended his approach by talking about lowering China tariffs. He said he reduced them from an initial 145% down to 100%.
Okay.
And he presented this not as backing down, but as, successful negotiation.
Right.
He also mentioned threatening the European Union with a 50% tariff, claimed it made them call really quickly to set up a meeting, and he apparently gave them a deadline, too, July 9th.
It's a specific date. He also, according to the source, made some broader claims about the economy at the time as part of this defense.
Yes, yeah. The source notes he described the U.S. as the hottest country anywhere in the world then.
Okay.
And contrasted that with how he claimed it was, like dying or stone cold dead just 6 months before that, referencing the previous administration.
And the exchange, as the source describes it, it ends with a pretty direct instruction to the reporter.
It does, yeah. The source quotes him saying, "Don't ever say what you said."
Okay, so let's get to the bottom of this taco trade term itself. According to the source material we have, what does taco supposedly stand for?
Okay, so, as the source lays it out, TACO stands for Trump always chickens out.
Wow.
Oh.
Okay, pretty blunt acronym.
Yeah, and the source attributes it specifically to Robert Armstrong, who's a writer for the Financial Times.
Okay, FT. So what's the specific market pattern this term is supposed to capture, based on the source's analysis?
The source explains it's this pattern where financial markets tend to react negatively. They often fall when tariff threats are first made.
Right.
But then those same markets tend to rebound. They rise again when the threats are seen to be paused or maybe rescinded altogether.
And the source even uses like an anecdote to show how predictable this pattern was apparently seen.
Yes, it does. It mentions an Australian economist who, according to this source, apparently joked about how long a specific Trump tariff policy lasted.
What did he say?
He apparently said it nearly lasted one entire long weekend.
Ouch. Okay, so the implication is the threats often didn't stick around very long.
That's the perception the source is pointing to, yeah.
Let's circle back to that chickening out claim then, and specifically the president's defense about the China tariffs, lowering them from 145% to 100%. The source we have looks at that move differently, doesn't it?
It definitely presents a counterargument, yes. The source claims that lowering the tariff from 145% down to 100% wasn't actually a negotiating victory.
It's not a win.
Not even really a negotiation, according to this source. It calls it a complete capitulation or a cave.
Why? What's the reasoning in the source?
The source's reasoning is that it was unilateral. He just lowered his own stated rate without getting any kind of reciprocal action, no concession from China in return.
Okay.
So, according to the source, this specific move is presented as like a prime example of him chickening out per usual. That's the phrasing used.
So if Wall Street perceived this pattern, according to the source, how did that actually translate into like an investment strategy?
Well, the source argues this perceived predictability led to a very specific trading approach. It actually quotes Ted Jenin,
Okay.
identified as president of Exit Stage Left Advisors, who was apparently quoted about this in the New York Post.
And what was the strategy?
The strategy, as he cited in the source, basically involved investors buying stocks when their prices dropped on the bad news, the tariff threat.
Buying the dip.
Exactly. Specifically because they were, and this is the quote, waiting for him to chicken out and watching those stocks rebound in value.
That's quite something. The source's conclusion from this is pretty stark, isn't it? The idea that Wall Street was literally banking off of his weakness.
Yeah, the source frames it very pointedly that way, suggesting professional investors were basically making money because they consistently assumed these tariff threats wouldn't actually stick, that they'd be walked back.
Now, the source doesn't just limit this perceived pattern to China or the EU, right? It gives other examples where it claims threats were made and then reversed.
That's right. One example it goes into is the threat of a 25% tariff on all imports coming from Canada and Mexico.
Okay, that's huge. What was the condition?
This threat was tied to demands that those countries take more action on illegal immigration and drug trafficking, specifically mentioning fentanyl.
And what happened after that threat? According to the source, something happened quickly.
Yeah, the source really emphasizes how fast exemptions started appearing, apparently within just 2 days of the initial threat.
2 days?
Yeah, the source uses the speed to claim he couldn't even maintain the threat for a full 48 hours before he started, carving out exceptions.
And the source even gets specific, citing an exemption for automotive goods from those Canada-Mexico tariffs.
Right. The source mentions this exemption came after meetings with executives from the big U.S. automakers, Ford, GM, Stellantis.
Industry pressure.
Exactly. And it includes a warning cited from Ford CEO Jim Farley. He had reportedly told investors that a 25% tariff across those borders would, quote, blow a hole in the U.S. auto industry.
Okay.
So the source presents this as evidence that the president would ultimately cave because his own policies, if he actually implemented them fully, would be, well, a disaster for major U.S. businesses.
So, stepping back a bit, what's the core reason the source claims these tariffs would go up and then just come back down?
The source's argument fundamentally is pressure, either pressure from the affected businesses or the negative reaction from the markets themselves, that this pressure would ultimately force him to back off the threats.
And a major negative consequence the source highlights about this whole on-again, off-again approach.
Uncertainty. The source argues that this inconsistent approach, and it particularly notes the Canada and Mexico tariffs here, just injected significant uncertainty in markets.
And how does the source connect that uncertainty back to, the listener,
Yeah.
to real-world impact?
Well, the source claims this uncertainty was actively hurting American businesses, American workers, and American consumers.
Okay.
It makes the argument that constantly making these big threats and then backing down actually undermined the goal of encouraging investment into the United States. Because it created this unreliable environment, how can businesses plan?
Right, that makes sense.
And the source even circles back to the president's defensive reaction to the reporter's question.
A nasty question.
Yeah. Interpreting that defensiveness as proof that, from the source's perspective, he knew the chickening out claim had some truth to it.
Okay, so if we pull together the source's overall conclusion here, this term taco talk, or taco trade, exists, according to this source, because it believes the president created this really predictable pattern, announce huge threats.
Right, followed by what the source calls immediate capitulation.
And the source really hammers home the idea that this perceived pattern just projected weakness, unreliability.
And suggested it allowed professional investors to, quote, literally bet against him following through and consistently win.
And the source even takes this idea of perceived predictability beyond just finance, doesn't it?
It does, yeah. The source argues that foreign leaders, trading partners, even adversaries could see this pattern too.
And what was the supposed takeaway for them?
But they learned they just needed to wait him out, or maybe make some minimal, token gestures, and he would eventually fold. It uses pretty strong language there.
So according to this source, it wasn't really the art of the deal.
No, the source explicitly contrasts it, calling it the art of the cave.
Wow.
And the source wraps up by saying his sort of wounded response when he heard the term just indicated he understood this perception existed.
Well, that was quite a deep dive into a very specific piece of source material. We've seen how a term like taco trade, supposedly born on Wall Street, can be used, at least according to this source, to describe this really complex interplay between political threats, market reactions, and this idea of predictable policy moves.
Yeah, it offers a very clear perspective, as presented in this source, on how a perceived pattern in policy could have pretty significant claimed effects on markets, sure, but also on businesses and even, international relationships.
It makes you think, doesn't it, about the power of predictability, or maybe the predictability of unpredictability in global affairs. How might simply the widespread recognition of a pattern, like the one described in this source, how might that influence decisions by investors, by businesses trying to plan long-term, even by other countries dealing with the U.S.? And what are the potential ripple effects when a pattern like that becomes widely recognized, really regardless of why it might be happening? Definitely something to consider.